Welcome to this Master Series special event, Conquering Compliance, Federal and State Unemployment Insurance. I'm Becky Harshberger, Vice President and Payroll Tax Practice Leader at Entertainment Partners, and I'm joined today by my colleague, Steve Wagner, Vice President, Client Partnerships. Steve, thanks for joining me to tackle this topic.
Hey, Becky, great to be here with you. Unfortunately, during the pandemic, many of us experienced unemployment. And I was wondering, first on topic today, if you can kind of walk us through what unemployment is and how that works in our industry.
So let's start with the federal side of things. Federal unemployment exists for two reasons. One,
Hmm.
so that the states maintain some kind of unemployment program. So it sets the bare minimum for that. And
Okay,
then secondly, it also creates a mechanism for states to borrow funds when they run out of money to pay unemployment
right.
claims. And that's, exactly what happened during the pandemic. Many states ran out of funds and they had to borrow money from the feds. And a lot of them paid that money back by using some of the federal funds through some of those benefits that the states were awarded. But there are a few states that did not use those funds to pay back the federal borrowing. And so, just keeping on the topic of federal, so what you'll find in that situation is that any state that borrowed during the pandemic and has not paid it back, then they pay it back by paying more in federal unemployment taxes in the next following years after they've borrowed. So the first year that they don't pay it back is kind of a freebie, get out of jail free year. The second
I
year
like
they
that.
don't pay it
I
back,
like that.
yeah, they have to start paying more in federal unemployment taxes. And it equates to $21 per employee in that second year of not paying it back. And then every year that it's still not paid back, you pay an additional $21. So for states that did not pay it back this year, those states, each employer will have to pay $42 per employee in
Gotcha.
2023.
Is that why we're seeing the additional, like, I think it's 0.6% in California? I believe it's in Connecticut, Illinois, and New York. Is that why we're seeing that?
Yep, yeah, that's exactly why you're seeing
Okay,
that. So the regular federal unemployment is 0.6% of 7,000, which equates to $42 an employee. But in those states, California, Connecticut, Illinois, and New
right.
York, our clients need to budget for double that amount or $84 per employee. And in 2024, it's looking like both California and New York will see another $21 increase, making what we call at EP FUI 2. It's a
Hmm.
separate line item.
Right.
FUI 2 in 2024 is going to be 0.9% or an additional $63 per employee, bringing your total federal unemployment in 2024 to 105.
Okay. Okay. That makes sense. So is that amount static for all companies? They all pay the same amount, Becky?
Yeah, it has nothing to do with the entertainment industry. And sadly, even new employers, like if you started a business last year, you're stuck with paying that additional amount as well if you're in one of those states that hasn't paid back what they borrowed. It's kind of a socialized system in that
Okay.
respect.
So, Becky, a common question that you probably know and you helped me field it many times is why is our state unemployment insurance so high?
And you know what? We have dealt with that a lot. And the key word there is insurance. And if
Okay.
you think about unemployment benefits like car insurance, car insurance goes up if you've had an accident or two, or if you've had a couple of speeding tickets, then your insurance rate goes up. And it's the same with state unemployment insurance. If you have a high rate of unemployment claims, then your unemployment insurance tax rate is going to go up possibly to the highest amount in a state. And our industry has hiatus. And when you're having a lot of unemployment during hiatus over the holidays in
Right.
December and January, and then again in the summer, we experience a high volume of claims and it just drives our rate up. And that's why you'll see those high state unemployment insurance tax rates in our industry. Yeah.
Okay. But I need to be honest with you, Becky. I know for a fact that some of our competitors do have lower rates. Why? Can you help me answer that?
I wish I had a crystal ball and I could figure out exactly how they're doing that. A couple of things come to mind. One is they could be using multiple state unemployment insurance account numbers, different ones in different years. They could also be using the pay agent model in some states for some clients and the employer of record model in other states like California. So that is not our business model. And if the client is the state unemployment insurance employer, then they're also the employer for federal unemployment insurance and for state and federal withholding taxes, which means they're using more of a payroll pay agent model rather
Mhm.
than an employer of record model. Entertainment Partners is a payroll company under the IRS regulations 3512, and we are fully responsible for federal unemployment, state unemployment,
Okay.
FICA, and workers' compensation. So all of those factor into the static unemployment account that we've had for years. And so we're kind of stuck with those higher rates.
Hmm.
And it's far more beneficial for a client to be with a company that has that stability, especially for those ancillary requirements like workers' compensation.
Right, right. No, that's important. I know that for unemployment, that would mean then that they would have to respond for 18 months after the last employee was on payroll. Is that correct?
Yeah, they have to respond. It's a requirement. If you're the employer for state unemployment insurance, you have to respond to those state unemployment insurance claims that are filed up to 18 months beyond the life of the production. So here in California, there's no penalty for not responding to an unemployment claim timely. But there are states, and many states, that will fine you if you do not respond to the claim within a certain amount of time. So it's really important to have that continuity.
Right, right. That makes sense. So there's a lot more involved when we talk about SUI, unemployment, and the claims, et cetera. There's a lot into this deep pond.
There's a lot going on behind the scenes, pun intended.
Yeah.
For state unemployment insurance, the wage base can also drive the cost. Let's take a look at a couple of popular states. The state of Washington wage base is huge. It's 67,600 with a maximum rate of 6.03%. If you're max rated in Washington, that could
Hmm.
cost you $4,076.28 per resident if they make that maximum $67,000. And
Right.
on the other end of the spectrum, even though clients say our state unemployment insurance tax rate in California is high, the wage base in California is only 7,000, which makes that maximum rate of 6.2% kind of cheap. It's only $434 per employee. And then you can see the difference with New York. New York's wage base is 12,300. Their maximum rate, which includes the New York interest assessment, is 10.08%. So in New York, for a resident of New York, the state unemployment maximum cost you would have would be like $1,239. So the wage base and the tax rate, combined together really drive the cost of that baseline unemployment insurance tax rate that clients see on their budgets.
So, just out of curiosity, Becky, help me on this one. Why do the wage base and the rates vary so much between states? It just seems kind of crazy.
It is kind of crazy. And the main reason is the amount of weekly benefits that a state gives to their unemployed. In Washington, we saw that large amount of wage base, and that equates to a pretty high weekly benefit amount. They can get almost $1,000. The maximum you can get in Washington in unemployment a week is $999. But in California, with that much lower wage base, the maximum amount that you can get is $450 a week. And in New York, with that kind of in the middle range there, 12,300 wage base, 10% ish maximum rate, New York's weekly benefit amount maximum is close to California's at 504. So the other issue driving the rates is the state's appetite for making changes to the unemployment insurance tax rate and the wage base. And California's state legislature strives to keep our taxes on the lower side. Probably nobody in our legislature in California wants to be that person that suggests raising taxes on employers. And secondly, some states really strive to build up their unemployment trust fund so that they can weather a pandemic or a recession. And some states are like, you know what, we'll just pay as we go. So if a state is trying to build up their trust fund, you're going to see that higher rate and that higher wage base.
So you mentioned disability claims earlier. How does that connected to unemployment?
Well, most states have tied state disability and paid family leave to state unemployment tax filings because they need that quarterly wage calculation to create the weekly disability benefit amount. But wait, there's more. For these states, California, DC, Hawaii,
Yeah.
Massachusetts, New Jersey, New York, Puerto Rico, Rhode Island, and Washington, not only do we have to administer state unemployment insurance and disability claims, but those taxes also provide paid family and sick leave assistance. So many states charge a penalty if you don't respond to an unemployment claim within a certain number of days, like I mentioned before,
Right.
and Entertainment Partners is responsible for responding to those claims well after a production has ended for both state unemployment and for state disability. They both can have pretty long tails up to about, 18 months.
Well, that's a good period of time. But let me ask you about this. There are some states that I know that run their own workman's compensation. How does that work, and what are those states?
I'm glad you asked. Time for a commercial. Coming soon, Conquering Compliance, the Workers' Comp Edition. So we will be discussing that in a separate mini master
Okay.
series. But back to your question, yes, there's a handful of states that require you to get workers' compensation directly from the state agency. And those states are North Dakota, Ohio, Puerto Rico, Virgin Islands, Washington, and Wyoming. They're known as monopolistic workers' comp programs. And this is another area that surprised clients who initially think that it might be cheaper to register and pay state unemployment insurance on their own, and only to find out that they're stuck with a monopolistic state workers' comp registration and payment as well.
So let's walk it out, because when I was an accountant and I entered post production, so if I had, which I never did, thank God, opened up my own SUI account or workman's comp account and is now going into post, then what happens?
So they'd have to have someone available to respond to work dates and wages up to 18 months after the close of production. So it really is important to the person collecting unemployment or state disability or workers' comp that the wage information and the dates of employment be made available to the agency that's administering those benefits. If the production company starts a new production within a
Mhm.
few years, then they'll need to reopen that state unemployment and that state disability account along with the accumulated experience that they had from all of those unemployment claims. And they'd likely end up with, the same rates that EP has.
Then why can't they just open up a new SUI account just to avoid that? Can't they just set up a new one?
They could try, but it's not a good idea. All states have programs that check for the movement of employees from one company to another, and they're going to investigate if they see the same group of employees moving from one company to another. And we know this because we do see companies that come to EP from a competitor, and we'll get a phone call from a state agency or a letter from a state agency asking about the transfer of those employees and asking if we are the same employer that previously reported those employees.
Mhm.
If the state finds that you are the same employer as previously employed those same employees, then they're going to potentially give you a penalty rate in addition to reopening that old account.
Wow.
Yeah, yeah.
So there's a lot going on there. So in addition to the long tail of unemployment insurance and disability claims that are out there, There may even be a workman's comp claim or two that go along with it. You now have to ensure that you comply with federal and state unemployment registration and workman's comp regulations and tax filings. That's what I'm hearing.
Yeah. And why do that? Why not just dump all of that on EP?
I never did. That was never
Yeah.
my. Thank
Yeah.
God.
Yeah. If you miss a claim or a filing, it can get really expensive really fast. Workers' comp claims can last for years, meaning the legal entity has to remain alive and you need to have someone there to manage that claim. So during the 12-month benefit year of a state unemployment claim, the claim can be reopened on and off as the person goes on and off hiatus. And every time a person goes on to hiatus, then that same claim during a 12-month period gets reopened and the employer again has to respond to it.
But here's another question, Becky. I get this sometimes that some clients call up and they say they mistakenly filed the production entity instead of Entertainment Partners as their employer record for unemployment. How does that get resolved? Is that a big problem?
It is not that big of a problem, but we do see it every now and then where someone says, oh, when they tell the unemployment office they worked for the production company instead of telling them that they worked for Entertainment Partners.
Right.
And if a production company does get an unemployment claim listing them as the employer instead of Entertainment Partners, they're going to want to forward that to tax support at ep.com and we'll respond and indicate, they're our employee and please redirect the claim back to EP.
Yeah, throw you another question. So what other things should a client know about unemployment, especially with this specialty market that we're in?
The only other thing I would mention is that there are a few states that are fiscal unemployment insurance tax states. In other words, the state unemployment insurance tax rate doesn't change on January the 1st. The rate changes on July the 1st. And there's 4 states that are fiscal states,
Hmm.
and they are New Hampshire, New Jersey, Tennessee, and Vermont. And I'll also mention, in terms of the confusion of the employee that is on hiatus or laid off, they should know that EP's state unemployment insurance account number is printed right on their check stub.
Right.
So that's to help facilitate the unemployment claim. And if they need a copy of their check stub, they can always go on to the employee self-service portal that we have, myep.com.
Becky, you're a wealth of knowledge, and that's why you're my go-to person for everything tax related. So I just want to say thanks for sharing your knowledge about federal employment, state unemployment, and workman's comp. Everybody should understand it, but it's a very complicated. I always love how you make it much more simple. So I appreciate that.
Happy to share. Along with this production of Conquering Compliance, be sure to tune into our workers' comp and disability sick leave editions.
Okay, great. So if anyone has any additional questions about SUI or taxes, I ask them to send it to the email taxsupport@ep.com. That's taxsupport@ep.com, or at the bottom of the screen, you can read it. And if you have questions about unemployment claims, you can send those to paymentsupport@ep.com. Again, that's paymentsupport@ep.com. Thank you, Becky. You're wonderful as always.
Thank you, Steve. Good to talk to you today.